Welcome to our deep dive on the spousal IRA and the crucial earned income rule. In this video, we will explain how the rule works, why it matters, and how to avoid common pitfalls. We will also walk through real-world examples, especially for gig workers, and discuss strategies for maximizing contributions while staying compliant. Let's begin by outlining what we'll cover. First, we will define the spousal IRA and the earned income rule. Then, we will contrast income sources that count with those that do not. Next, we will address the complexity for self-employed or gig workers, including how to compute eligible income. After that, we will discuss contribution limits and an illustrative scenario. We will also explore a controversial but legal strategy used by some high earners. And finally, we will examine alternatives when IRA limits are maxed out. We will wrap up with key takeaways, quizzes, and a clear call to action. Before we proceed, please note that this content is for educational purposes only. It is not tax, legal, or investment advice. Contribution limits and definitions can change, and individual circumstances vary widely. Therefore, for any decisions, you should consult a qualified tax professional. With that in place, let's move into what a spousal IRA actually is. A spousal IRA is not a different type of IRA. It's simply an IRA for a spouse who does not have their own earned income, funded based on the working spouse's taxable compensation. The couple must generally file a joint tax return. The core idea is that the non-working spouse can still save for retirement if the working spouse has sufficient taxable compensation. Next, let's focus on the single most important rule that governs whether contributions are allowed at all. The single most important rule is that the non-working spouse's IRA contribution depends entirely on the working spouse's taxable compensation. That compensation must come from work, such as wages or net self-employment earnings. If the couple does not file jointly, a spousal IRA is generally not available. Additionally, the total of both spouses' IRA contributions combined cannot exceed the working spouse's taxable compensation for the year. Passive income like dividends, interest, pensions, and required minimum distributions do not count as taxable compensation for IRA purposes. Next, we will unpack the income trap of what counts versus what does not. A common pitfall is misunderstanding which income sources qualify. Compensation that counts includes wages and salaries, tips, commissions, bonuses, and net self-employment earnings. In contrast, passive or portfolio income such as dividends, interest, rental income, pensions, Social Security benefits, annuities, and required minimum distributions do not count as compensation for IRA contributions. Remember, if you file jointly, the sum of both spouses' IRA contributions cannot exceed the working spouse's taxable compensation. Now, let's visualize this distinction to cement the concept. This mind map separates two branches: compensation that counts and items that do not. On the counted side, we have wages or salary, tips and commissions, and net self-employment earnings. On the not counted side, we include dividends, interest, capital gains, rental income, pensions, Social Security, and RMDs. The intent is to provide a quick mental model that you can recall when deciding whether your household has sufficient taxable compensation to fund one or both IRAs. With that foundation, let's examine the special complexity faced by gig workers and the self-employed. For gig workers and the self-employed, eligible compensation is not simply gross revenue. Instead, you begin with your Schedule C net profit. Then, you compute self-employment tax on approximately 92.35% of that profit. Next, you take the deductible half of the self-employment tax, which represents the employer portion. You then subtract that deductible half from your net profit. The resulting number is considered net earnings from self-employment for IRA compensation purposes. This amount sets the maximum that your household can contribute to IRAs, subject to the annual per-person limits and age-based catch-ups. To make this concrete, let's look at an illustrative example with approximate numbers. This table illustrates a simplified example. Suppose the Schedule C net profit is $40,000. Self-employment tax is assessed on approximately 92.35% of that profit, resulting in about $5,652 in self-employment tax. The deductible half of the self-employment tax is about $2,826. Subtracting that amount from the net profit yields approximately $37,174 of eligible compensation for IRA purposes. The household's combined IRA contributions cannot exceed this eligible compensation, and each spouse is still subject to their own annual contribution limit and any applicable catch-up amounts. Next, let's test your understanding with a quick quiz. Question: which of the following counts as taxable compensation for IRA contribution purposes? Option A, dividends from a brokerage account. Option B, required minimum distributions. Option C, net earnings from self-employment after subtracting half of self-employment tax. Option D, interest from certificates of deposit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is net earnings from self-employment after subtracting half of self-employment tax. Dividends, interest, and required minimum distributions are all passive or retirement income and do not qualify as compensation for IRA purposes. Now that we have reinforced what counts, let's look at the annual limits and a common scenario involving catch-up contributions. Annual IRA limits apply per person, with a higher limit for individuals age 50 and older. Currently, the catch-up raises the limit to $8,000 for those 50 or older. Each spouse has their own respective limit, but the sum of both contributions cannot exceed the working spouse's taxable compensation. For example, if a 64-year-old working spouse contributes $8,000 and has only $8,829 of taxable compensation in total, the retired spouse can contribute only the remaining $829. As we continue, let's visualize the flow of time and key deadlines around contributions. Here's a timeline of key milestones. First, you must earn compensation during the tax year. Next, you may contribute for the prior year up to the tax filing deadline, typically in mid-April. Finally, if you inadvertently exceed the allowed contribution, you should correct or withdraw the excess before the filing deadline to avoid penalties. With timing in mind, let's tackle a quick scenario quiz. Question: if the working spouse earns $8,829 and contributes $8,000 to their own IRA, how much can the retired spouse contribute? Option A, $0. Option B, $829. Option C, $1,000. Option D, $8,000. You may pause the video now to consider the answer. We will discuss it in the next section. The correct answer is $829, since the combined total cannot exceed the working spouse's taxable compensation. $8,829 minus $8,000 equals $829. Now, let's discuss an advanced strategy sometimes used by high net worth households. In some cases, households legally hire a spouse to perform actual services in a business, creating additional taxable compensation that can support IRA contributions. Wages must be reasonable for the work performed. Duties, hours, and payments should be documented. Payroll, tax withholding, and labor rules must be followed precisely. It is essential to coordinate with a qualified professional to avoid misclassification or compliance errors. To further clarify this, let's weigh the potential benefits against the risks. On the positive side, hiring a spouse can create the eligible compensation necessary to fund both IRAs. It formalizes the spouse's role in the business and may offer ancillary benefits if legally and properly structured. On the risk side, there is a significant compliance burden involving payroll, labor regulations, and tax withholding. Wages must be reasonable for the duties actually performed and fully documented. The approach can invite audit scrutiny if duties are unclear or unsupported. Administrative costs can also reduce or negate the financial advantage. If this path is considered, professional guidance is essential. If you lack the required earned income for an IRA, or if you have already maxed out your limits, a taxable brokerage account becomes the flexible alternative. It offers unlimited contribution capacity and easy access to funds. To preserve after-tax returns, focus on tax efficiency by considering broad index funds, longer holding periods to benefit from favorable capital gains rates, and asset location strategies when appropriate. Automated savings and periodic reviews help maintain consistency and discipline. Now let's distill today's most important points. The key points are as follows. First, the spousal IRA depends on the working spouse's taxable compensation. Without earned income, contributions are not allowed. Second, the combined contributions for both spouses cannot exceed the working spouse's eligible compensation. Third, Gig workers must reduce their net profit by the deductible half of self-employment tax to determine eligible compensation for IRA purposes. Fourth, catch-up contributions increase limits for those age 50 and older. Fifth, hiring a spouse can be done but requires legitimate work, reasonable wages, and strict compliance. Finally, if IRAs are ineligible or already maxed, taxable brokerage accounts are a flexible and effective alternative. In summary, always ensure you file jointly and confirm that the working spouse has sufficient taxable compensation before making spousal IRA contributions. For self-employed households, calculate eligible compensation carefully and conservatively by subtracting the deductible half of self-employment tax. Document your process and consult a professional to prevent excess contribution penalties. Remember that rules and limits can change, so verify current IRS guidance before taking action. As we wrap up, we'd love to hear your thoughts and questions. Thank you for watching. If this video helped, please like it, share it with someone who could benefit, and subscribe for more practical guides. In the comments, describe your household situation or questions, and we may feature it in a future episode.